If you own all the small team sports in a local area, and you just decide to jack up the prices to increase your margins, and you're playing on a parent's FOMO for their kids, yeah, your small sports team is now more profitable. Are you necessarily adding any value? Hello everyone, I'm Seth. This is Acquired Salary. In today's video, I'm going to talk about oligopolies, and we're going to do this by reacting to How Money Works video, or Economics Explained. I can't remember who it is. Before we get into it, if you're new here, welcome. If you're returning, welcome back. I'd greatly appreciate it if you drop a like on this video. I'm shooting for 50 likes this video. And with that, let's jump into things.
This might come as a shock to you, but big companies are getting bigger. Rich people are getting richer, and vital resources like housing, business equity, food, and even water are now owned by a smaller share of people than ever before. Groundbreaking journalism, I know. But what most people don't realize is just how concentrated this has really become. Private equity now controls as much as 20% of the entire US economy.
Fun fact about private equity is the industry that creates the most billionaires. So that explains why it's becoming so popular. People are trying to get wealthy.
Top index funds now owns 20 to 30% of all major companies listed in America, and even good old-fashioned fraud is getting bigger and more concentrated. And who can blame them? Economies of scale have encouraged businesses to scale markets, responded to too big to fail by becoming too big to fail. But what does this actually mean for regular people? There is the moral argument that so many resources being controlled by such a small few is, unfair. But
I don't think it's necessarily unfair, because it just inherently comes down to people and their abilities. Some people are going to have the ability and the foresight to manage so much capital as others are not. And that's why we see this Pareto distribution and consolidation of very few wealthy people having the vast majority of the wealth, is because they're the ones that are actually able to manage that amount of wealth. But whether it's properly distributed in the current system, who knows? We'll see what else they have to say in this video.
let's be honest, you've already made up your mind on that, and no YouTube video is going to change it one way or the other. Instead, what actually matters here is how much further this can go, and what happens to markets when these people have nobody left to sell to but themselves.
The last quarter, you were able to buy, looks like, a little bit more than 1,500 homes for $656 million.
These investment companies, they want to make money. That's what they're there for.
Outrageous is your tax dollars are helping Wall Street.
Yeah, in terms of private equity companies like BlackRock or Blackstone, my neighbor's house, they sold to Blackstone. Blackstone paid all cash for it, and then they put probably $100,000 to $150,000 worth of work into the property, and now they rent it out, and they have a absolutely terrible management company. And yeah, so it's very common that these private equity groups and just investment firms in general are investing in single-family homes, but they're not owning as many single-family homes as a lot of people think they are, but it still has an impact on housing prices and the market.
Buy a single-family home. You're subsidizing Wall Street.
Water Asset Management is a Wall Street investment firm with offices inside this building in New York City.
That as water becomes scarce, Wall Street sees profits.
Elon Musk, the world's richest person, is now the first person to have a net worth surpassing $400 billion.
Private equity has become the boogeyman of finance, just like hedge funds were in the 2010s, and sometimes for a good reason. Average people have been told to hate them. Insufferable Wharton grads want to intern with them, and the industry is making more billionaires than oil, real estate, and even technology.
Exactly what I said at the beginning of the video.
The question is, are they creating value or just extracting it?
I would say yes and no. There's creation of value, but a lot of the private equity strategy is what you call a roll-up. So from that standpoint, I could buy a plumbing company, then buy an HVAC company, and then buy a electrician company, and then consolidating all of those businesses without necessarily changing anything about the individual businesses, combining them into one business that increases their profits overall. And the way it works is, on the smaller scale, you have seller's discretionary income, but then on a larger scale, you get into EBITDA, and when you hit certain EBITDA amounts, you increase the multiple the business is worth. So this is how private equity is just extracting value, not necessarily creating value. Yeah, technically you're creating value by consolidating these three different home service companies into one, but if you do it very quickly, it's not necessarily going to be adding a whole lot of value because there's going to be a lot of things that could fall through the cracks in terms of professional management.
These alternative investments used to be exactly that, alternatives. But the private equity market has changed in just the last 15 years from a small niche that was popular with a select few families to one of the biggest asset holders in the world. Because private equity is private, it can be hard to accurately estimate just how much capital is controlled by these firms. But a report published by the management consulting firm McKinsey & Company estimated that it was over $13 trillion as of June of last year.
Not
Given general
surprising.
market conditions and fundraising, it's likely to be even higher now. Now, there is nothing actually that special about private equity. It really just means any investment made into a business or security that is not listed on public markets. So if you invest $1,000 in your brother's farmer's market stall, you are technically a private equity investor. So, make sure to slap it on the LinkedIn profile. So the reason that private equity got so big so quickly has nothing to do with it being an amazing investment or anything silly like that. It's purely the result of a financial system that has become too concentrated.
And again, a part of the reason that private equity has such high value is because it's not publicly traded. So there's less market verification of what the company or firm is necessarily worth. So that's where we can have such large estimations of private equity wealth. But the truth is, you can be valued at $1 billion company, but if nobody wants to buy your company for $1 billion, is it really worth $1 billion?
American economy, finance, and business activity are all much bigger than they were in the 1990s, but the number of publicly listed companies has actually gone way down since then. In fact, it's almost halved in the same time the economy has tripled in size.
And again, from that point there, you have all these regulations that you have to go through because of 1933 Securities Act, and to overcome and prevent another stock market crash, we have the SEC, and then we have FINRA, which reports to the SEC. And so we have the SEC. In order to be publicly listed, you have to have certain disclosures. You have to have your prospectus. You have to have annual 10K reporting, and then I think it's 10Q reporting as well on a quarterly basis in order to be traded on a public market. Well, if you're a private equity investor, you don't necessarily receive all that same information. Well, in a roundabout way, you're going to receive the same similar financial information to come up with the value that you would want to purchase business for, but it's not as regulated. So if you want to build a lot of wealth really quickly, you have less regulation, and it's just about making a deal with a company for what it's worth, rather than having all the additional reporting requirements through the SEC to become publicly traded.
Now, one big reason for there being less publicly listed companies is simply because bigger companies have been acquiring smaller companies at record rates, making for a more concentrated business environment with fewer companies overall, which is...
that's a oligopoly or monopoly. So monopoly is a company that owns the entire market for a single service or product. Well, monopsony is like Amazon. They own the vast majority of the market for multiple services or products.
The whole point of this video. But we will actually get to the consolidation later. There are also fewer companies IPOing in the first place, because there really is no need to anymore. Companies list themselves on stock exchanges to raise money from the public, hence why it's called an initial public offering. But the general public just doesn't have that much money anymore. The wealthiest 10% of Americans now own 93% of all publicly listed stocks. The vast majority of capital flowing into public stock markets comes from people or institutions that are rich enough to invest in private equity, so the regulatory and reporting burden of being a public company just simply isn't worth it to get access to 90% of people who all collectively own just 7% of the market. That 93% of stock ownership is largely held through retirement accounts, which are handled by funds which can invest into private equity as well. So for most companies, it just doesn't make sense to go public anymore. Now, alright, so what? People have slightly fewer options to ape their life savings into on Robinhood. Well, apart from that, this trend, which has only really been going on for 15 years at this point, is really causing a lot of problems and costing you a lot more than you realize. The first issue that doesn't get nearly enough attention is how they have created micro-monopolies. When you think of monopolies, you are probably going to think of giant companies that own entire markets everywhere across the world, like, well, YouTube. But a much more common type of monopoly has started to become a bigger problem. These are small, local monopolies. One of the hottest new private equity investments has become youth sports leagues. Little League is a great investment because firms can buy up all the sports in a local area and create a monopoly on competitive team activities. And nobody wants to be the parent that denies their child the opportunity to go and touch grass with their friends. According to a report...
Which, from that point, if you own all the small team sports in a local area, and you just decide to jack up the prices to increase your margins, and you're playing on a parent's FOMO for their kids, yeah, your small sports team is now more profitable. Are you necessarily adding any value? Not necessarily.
Or by the Aspen Institute, these local leagues are collectively a $30 billion industry, and they are becoming more expensive as they are consolidated by private equity firms. Now, this is just one particularly scummy example, but creating local monopolies is just a good business strategy. It's not technically legal, but the Federal Trade Commission just doesn't have the manpower to identify and enforce these thousands of local issues when they don't even really have the resources to go after the most obvious monopolies. These subtle consolidations have changed how and where we spend our money, but it has had a much more serious impact on how we earn our money. So it's time to learn how money works to find out if it's possible to reverse the concentration of everything. This week, another major problem with a lot of businesses being owned by a very small group of investment firms is that it makes it really hard to see what is actually happening in our own economy. Public companies have to release regular financial statements, and their market value is updated every...
Yeah, your 10K and your 10Q. That's quarterly and annual reporting, which has to be audited. So, again, less transparency, but that's how you can get these extremely large valuations for private businesses or private equity.
Every microsecond as their stock is traded. As more of the market is held by a smaller group of investment firms, it gets harder to tell how these businesses are performing and how they are being run. John Coates, a professor of law and economics at Harvard, recently released a book called The Problem of 12, when a few financial institutions control everything, which addressed exactly this problem. Specifically, he mentions that pension funds have found private equity very attractive, and since most pension funds are investing on behalf of regular people, it can be very difficult for those people to see how their money is being used since there are two financial institutions between them and the business they are actually investing in. Coates also speaks about the concentration of capital in index funds like Vanguard, BlackRock, and State Street. He doesn't highlight the usual criticism like Larry Fink being a lizard man that secretly controls the global economy, but he does raise the issue that the way these financial products invest money makes normal price discovery much harder and also incentivizes getting more concentrated.
Yeah, I mean, when you have not 100, you don't have 100% transparency on what's going on from one institution to the next, and then once you're twice removed, you're going to have less visibility and less understanding, which obviously makes it more difficult to have an idea of what the companies are investing in and all of that information that he's just made the point of.
Something like Vanguard's VOO ETF just mindlessly takes investor money and puts it directly into the weighted average of the 505 stocks that make up the S&P 500. And yes, there are actually 505 stocks in the S&P 500 because some companies list Class A and B shares. Finance bros aren't very good at naming things. This means that a large share of investors are just investing in whatever has the most investors, which has just helped contribute to immense valuations of companies at the top of the market. The amount of capital concentrated through these investment managers means that they now have significant influence over company shareholder votes, and new products like ESG or green ETFs can have more influence over board decisions than they really should have. There will be a link in the description below to that book if you are interested in reading the whole thing, though you should know it was written for MBA students at Harvard, so it is a little bit dense. He also gave a half-hour interview just last month available here on YouTube, which is also worth checking out. Another big problem is corporate debt. Most of the biggest private equity firms in the world use what's called a leveraged buyout. This is where they will buy a whole lot of companies, get those companies to take out big loans, and then use the borrowed money to pay themselves back so that they can go and buy even more companies. This normally involves...
Which is, again, something that continues to encourage the consolidation of companies because you're able to do the leverage buyout.
A lot of cost cutting in the business so they can make their repayments. But on a wider scale, it's contributed to the record levels of corporate debt that we have in America today, which as a percent of GDP was only higher during the first wave of PPP loans, and just after the global financial crisis. Businesses always want...
Because that bodes well for the current state of our economy, right?
To get more concentrated. It's the natural order that big businesses will acquire little businesses or put them out of work. The rise of private equity, the proliferation of passive index funds, low interest rates, and the flaccid approach of regulators has only made this natural process much faster. But this still isn't the worst part. Corporate concentration has made finding competitive job opportunities extremely difficult, especially for people in smaller communities that have had local businesses quietly rolled up by large investment funds.
Exactly. So the roll-up is what I was talking about. You know, another option for increasing, well, in terms of increasing the gross profits of a business, you can increase the lifetime value of your customers, and you increase the lifetime value of your customers by increasing prices, like I talked about in the small sports league example, or you can reduce your churn of customers. So if you're a plumbing company and you lose your customer to a different plumbing company, one of the ways that one of the other private equity strategies is, okay, I have an existing plumbing company. Well, in order to increase the total profit of the business if I'm not focusing on the lifetime value of my customer, I'm going to focus on increasing the number of customers. One of the fastest ways to increase the number of customers is to buy out the other plumbing company in your small local area, which again can be a roll-up and consolidation of all the local plumbing companies, which I'm sure he's going to go into how it decreases the availability for negotiating price or your salary when it comes to, oh, it's all owned by the same person and the same person has this as the requirement for whatever profit margins they have.
The best way to get a higher salary as a worker is to switch jobs for better opportunities. But if you are a plumber and all of the plumbing businesses in the local area are owned by the same holding company, you aren't going to be able to negotiate like you would with competing businesses. Now, if you think you could get around this problem by starting a business of your own, well, actually it gets even worse. In an article published by the Washington Post, Lillian's...
Again, if you're in a monopolized market, well, if you want to come into that small local market as a competitor, what is the holding company necessarily going to do? Well, they're going to identify your competition. They can either buy you out, which they probably won't want to do. They'll just drop their prices and run you out of business, as monopolies do.
Salerno, a healthcare entrepreneur, spoke about her difficulty in bringing a new, safer medical syringe to the market because businesses up and down the supply chain had become highly consolidated, so they didn't want to work with a potential competitor even if her product would have been better for patients.
And again, that is a great point that she makes in terms of if you as a small competitor want to, bring a new competitive thing to the market, yet 90% of your manufacturer's business is from your other competitor, they have a lot of leverage of that situation in terms of, oh, you're working with this other competitor, we're no longer going to work with you. That threatens your manufacturing business. So it all makes sense in terms of the incentives and the downstream consequences of monopolies being present in the economy, having a very dramatic and negative impact on the overall state of the economy and affordability of certain things, as well as what you can negotiate in raises and how easy it is to compete in that market.
It's technically anti-competitive practice, but again, regulators are understaffed and underfunded. It's even worse in highly scalable industries like technology. The most important thing that early-stage investors now look for in startup companies is an exit strategy, which is just business speak for who is going to buy this company if it's successful. Those buyers are either a few of the industry top players or a private equity firm. The result of this is that only companies with the highest potential to...
And private equity firms, one of the things that they have in terms of advantage over private buyers is private equity firms can typically probably pay a little bit more of a premium because they have a grander... they have more capital to invest with, or they have other tools in their toolbox to pay a higher price, so that if you have slaved away building a business for over 20 years and you want to have a nice retirement, it comes down to the question of money. Like, what's more important, having the small local business in your community that's owned by a private owner, or do you want to sell out to private equity? And private equity can understand that, oh, some people really want to have those small local businesses still. And they typically try and overcome that by just paying a higher premium or a higher multiple of your EBITDA or your seller's discretionary income.
Scale and the best opportunity for acquisition actually get funded, which is why places like Silicon Valley have gone from making technology to solve the world's problems to writing algorithms to keep you watching your phone for an extra 20 seconds a day. A blog post written by Ross Bears, who is ironically the president of a venture capital firm, called this the stagnant pool of American entrepreneurship. If you wanted to start a company tomorrow, you probably wouldn't know where to start, especially if you had to go and raise capital from professional investors. There are programs like Y Combinator that incubate early-stage companies, but access to these programs is highly competitive. The people that have the connections and experience to get these businesses started also know that the best way to run these businesses is to just build it so a bigger business comes along and buys it. The people...
And again, this is one of the selling propositions of Ivy League schools. It's not necessarily about... Obviously, you do get depending on what you study, you can get a really exceptional education at an Ivy League school. Yet, at the same time, one of their biggest selling propositions is the connections that you make with people that can, if you build a startup company, oh, they work at a private equity firm that can buy your startup company when it hits its mark and its stride, and you want to make your exit. So again, there's a lot of backdoor politics being played.
People that have felt this the worst are the tech bros. An entire generation of people were told that if they just learned to code, they would have a stable career for life. Go and watch my video on the rise and fall to find out how instead it just turned into a giant casino where workers either get life-changing payouts.
Yeah, overall, what do you think? Please share your thoughts and comments in the comment section below. And if you've made it this far into the video, you may as well subscribe to this channel so you don't miss out on future videos just like this one. Or you can just check back to my channel on 6 p.m. Tuesday, Wednesday, and Thursday every week. Until next time, thank you.